Hi everybody, this is AJ speaking. Today I want to discuss Meta's latest quarterly performance and what it means for Nvidia. Here you can see Meta's last 5-year share price performance. You can see the stock more than doubled, is up 231%. And here, key number, market cap, Nvidia is right now worth almost $1.8 trillion. It's almost $1,800 billion. And just as I said in my Microsoft earnings review, this is the name of the game. Meta has to defend this huge market cap. And that's why they need to be amongst the winners in AI. But first, let's take a look at Meta's performance. Here you can see total revenue development by quarter. And you can see that the fourth quarter was an absolute all-time high for Meta. The company grew almost 21% year on year, almost over 19% quarter on quarter, and finished the full year 2024 with almost 165 billion in revenue. That is up 22%. And let's just recognize at this scale, this is a phenomenal numbers, incredible to be honest. And that's why Meta's huge market cap is justified. But of course, if you have created huge value, others will try to steal some of your value. So on this slide, we look at total gross profit. Also enormous growth, all-time high, almost 40 billion in just gross profit, which is wild. And for the full year, Meta generated 134 billion in gross profit. The operating profit number is similarly crazy. Meta grew almost 43% year on year to 23 billion in operating profit, 35% sequentially, so quarter on quarter, which is also quite wild. And for the full year of 2024, Meta generated 69 billion, up 48% year on year. Also absolutely wild numbers. Then the net income, also crazy numbers, 21 billion almost in net income. 69% year-on-year growth rate for the full year. Full year of 2024 delivered 62 billion in net income. So we're talking really large numbers here. But all of this, keep this in mind. So Meta is performing exceptionally well, extremely high profitability. Then here we look at cash flow. Cash flow quite strong, and keep in mind this is cash. So cash flow is operating cash flow less capital expenditures. So the residual, effectively, after you paid for all your AI investment, this is what left. So despite, and you see it in a second, despite insane growth in capex, which is investments, which is mostly investments in AI infrastructure and other compute infrastructure, has grown insanely. But despite this crazy growth, because the business is performing so exceptionally well, cash flow has barely taken a hit. You can see cash flow is up 15% year on year in the fourth quarter to almost 14 billion. Yes, it came down 17% quarter on quarter, but this was from a record high. And Meta still, despite the record high capex spend, finished the year with almost 54 billion in free cash flow. And again, this is after Meta paid for all the capex. So this already gives you some idea where we're going. Then here you have the capex expand, as you can see, completely went through the roof. As I predicted last year, I looked at the bullish guidance. I provided this chart in a forecast and I nailed it. And you can see it, and a lot of people called me kind of crazy at the time, but it was obvious. So Meta massively leaned into AI investments. And we talk about the guidance in a second, but the key point is Meta continues to lean in on AI investments, and here just at the number, when you look at these numbers, Meta almost spent 15 billion in a single quarter on AI. In the total of 2024 was 39 billion. But of course, this also includes other capex, but the majority of this goes into AI infrastructure. And when you compare this to prior years, in 2022, Meta spent about 32 billion. Then it came down in 2023, which was a more difficult year for the company, and then 39 billion in 2024, which was kind of a turnaround year for Meta. And then when you look at sort of the liquidity side of the equation, the debt balance stayed constant. It's also an important consideration when we look at the next slide. you can see that the cash balance has increased, and this was not debt driven. This was driven by positive free cash flow, as you just saw, because the debt balance stayed constant. So despite, let's just really quick recap, despite record high capex spend, debt unchanged, cash balance still growing to a record high of 78 billion. So basically, Meta fires out of all cylinder, business doing exceptionally well. The company is spending like crazy on AI, but the key point is they can afford it, and they can even expand on it. Here's a margin overview. Here it gives you some idea what's driving this. Meta's gross margin has very high consistency, always just around 80, 82%, which is a fairly narrow margin. There's some outliers obviously, but overall fairly consistent. So what was really driving this was the operating expense side, and you can see this here in the red or dark orange line, which shows you the operating margin, and you can see this has ticked up significantly from the low, the interim low in 4Q 2022, where Meta's operating margin dropped down to just under 20%. It was a long-term low, but since then operating margin increased significantly, and in 4Q 2024 Meta generated slightly over 48% operating margin, which is wild. And these are dream margins. This is similar to Microsoft. They also have insane margin. Of course, it's software business at scale, which should deliver these outstanding results, and this is what we are seeing here. And then we were looking at the profit after tax margin, also insanely high. And when you look at this is a long-term high. So when you look at all these key metrics, revenue, gross profit, operating profit, net income, margins, and all these things, on all of these metrics, Meta performed currently exceptionally well. And this is fueling basically Tesla's, Meta's AI ambitions. And here we focus now on the key statement from the recent fourth quarter call. And in the call, Meta stated that for the full year of 2025, they expect capital expenditures to exceed, capital expenditure to be in the range of $60 to $65 billion. And what this means shows this chart. So I used this input, 60 to 65 billion, and I took the midpoint. The midpoint is 62.5 billion, and I extrapolated from the all-time high 4Q quarter what that would mean if you just kept growing your capex to hit that 62.5 billion. So this is just very simplistic based on Meta guide, and this gives you an idea how insane Meta's capex spend is. But as you just saw, the business can afford it. That's the key takeaway. So this is not crazy. And as I said in my Microsoft review, back in 2023, people looked at hyperscalers, Microsoft and other companies, and also at Meta, and they were saying, oh, they can't afford it, they can't keep increasing spending. And then when you look at the full year numbers, Meta, just like Microsoft, they substantially increased the capex spend. And 2025, same thing, Meta keeps significantly increasing capex spend. And the same we saw in Microsoft. Of course, these companies, they try to hedge their bets. And Nvidia is not the only game in town; it's by far biggest game in town. But of course, they try to move some workloads to custom silicon and other Nvidia alternatives. But the bottom line is, when you look at these numbers and when you look at the industry capacity, etc., when you add all these breadcrumbs together, what you will quickly see is that a significant share of this growth basically has to go into Nvidia. And the reason is quite simple. The rest of the industry, they can't simply absorb this much demand from one year to the next, because in 2023, because companies have reported, etc., we know Nvidia must have absorbed the vast majority of the growth and has a huge market share. and therefore we know that the non-Nvidia capacity is very low. Of course, people have expanded the capacity, but when you look at the sequential, the year-on-year increase from 2024 and 2025 that is implied by the company's guidance, you basically have to assume they can ramp within a few quarters by 500% or 1,000% in some cases, which is, if you understand semiconductor industry a little bit, this is simply not possible. And I'm sure they planned for this all year 2024, but still, when you look at the investment flows at the large chip makers, TSMC is a very good example. TSMC is the biggest taker of the high-end chips Nvidia is the biggest taker of TSMC chips and from industry sources, you can learn that and Nvidia basically took most of the 2025 capacity, and hence it's basically not possible that these companies can push the majority of their increase into non-Nvidia, and this is very bullish for Nvidia in 2025. And the other thing I'd like to mention is do not apply hockey stick thinking, okay, this is 2025, what happens 2026? Nobody knows, but these are very big ships, these companies, and it's unlikely that all of a sudden all the capex spend evaporates. You see this business perform extremely well, and that fuels the further investments, because again, the name of the game is defending market cap. You have to be seen as when you're like a multi-trillion-dollar market cap company, you need to be seen as a winner in the AI race, and that's why you try everything. You of course try to exploit all efficiency gains that are being delivered by approaches like those that DeepSeek delivered, but of course you also try to use everything else, and brute force, huge compute is one tool in your tool set, and overspending 50 or 100 billion and talk about this Zuckerberg is like, not a primary consideration in this AI arms race. With that, see you in the next video. Thanks for listening. Bye.